morning. It's Quant Trade Edge, and today I wanted to go over a scalping pattern called the umbrella. I've mentioned it a few times in prior videos, but I've never really given a thorough explanation of it. And on Friday, there were several such examples, so I thought it'd be a good time to make this lesson. In a bullish umbrella, you basically have a fairly large candle, but then a significant upper tail. That upper tail would be greater than the lower tail. And what this tail represents is a fair bit of rejection as price tried to move higher. And then what happens the next day is you have an inside bar, but what's unique about this inside bar is the body of the second day falls entirely within this upper tail of the first day. And if you think about what that means that this area that got price rejection, you're starting to get acceptance in that area, and the meat of the trading between the open and the close is happening in that tail. And typically there are, on the second bar, you'll have a larger lower tail and a small upper tail, and this large lower tail represents the fact that price tried to push down and got rejected. So, this buying in here was solid, and when price dipped back down, it came right back up. And what this sets up for is when you break the high of the first bar, usually the first bar or two up, bar or two after that, you get some follow through. But this is a scalping pattern, so this doesn't have long-term predictive ability. It's just pretty much the next bar or two. The bearish umbrella is the same thing to the reverse, where you have a candle that had a significant body, red candle, with a larger tail below it than above it. Again, signifying that price got rejected here initially. On the following day, this inside bar has its body within the tail of that first bar, indicating that price is starting to get accepted down there, and this move attempt higher got rejected. And again, when you break down below the low of this first bar, that's when this pattern would trigger, and again, would expect 1 to 2 bars of downside from this pattern. So let's jump to the examples that were here on Friday. And if you think about what causes this pattern, if you break it down to a lower time frame, this is kind of a cup and handle pattern. You have this push down, and then you have some consolidation and flagging in this area before a continuation move. And we can see that in the examples today. On the British pound, Wednesday was this bar up with the big upper tail. Thursday was the second bar in the umbrella pattern, where we got price acceptance in this tail, almost no upper tail, and the lower tail got rejected. When we broke above that high, we got significant follow through on Friday. And we can take this down to a 30-minute chart. But if you notice, this is a little bit sloppier than most examples, in that this did test significantly into that bar, although it was rejected. But if we take this down to a 30-minute, you'll see what basically happened here. The 25th, so starting around here, this was the first bar to the upside. And in fact, the day went as far as here, but essentially you had this impulse, and then you had this whole day of building value at this upper end of the range and just going back and forth within the range. And when we broke above that high, we got significant follow through. So you can see what the 30-minute pattern looks like on this daily umbrella that was on the British pound. And then again, if you analyze this pattern, it's just like what I put up in the PowerPoint a second ago, and that's these two bars right here. There was also an example of this on the 5-minute S&P chart. On the 5-minute S&P chart, you had this significant green candle with a significant upper tail, larger than the lower tail. The next bar, you had a body building value inside that tail with a larger lower tail than upper tail. And this was 8:45 and 8:50. So let's drop it to a 1 minute and see what that looks like. 8:45, 44, so 45 to 8:49, so that's 8:50. It's 5 minutes. So you had this impulse, and then you had this sideways action. And then this was kind of a little bit of unique where one bar kind of broke down below, trapped, and then went higher. But again, if you look at these two bars in isolation, this is the 5-minute bar that would be bar 1 of the umbrella. This is the 5 minutes that would be the second bar of the umbrella. The first bar is an impulse. The second bar is, call it a cup and handle, call it a, just high flag, a consolidation, whatever you want to call it. That's essentially what it looks like on the lower time frame. And another example to really blow your mind, a 1 minute umbrella right here, bullish umbrella, and this was 11:41, 11:42, and you can see how you got the initial 3 minutes up from that pattern. And this program is beautiful in that we can actually take it down to, say, a 5-second chart and see what that looks like. Or maybe a 10-second chart. So we have 6 bars. 11:42. There we go. So again, we have the impulse. So starting at 11:41, these 6 bars, 1, 2, 3, 4, 5, 6, would have been the first bar of that 1 minute hoagie. And then this little bit here is the second bar of that 1 minute hoagie. And when it broke out, we got 3 minutes to the upside. So again, markets are fractal. We first saw the pattern on the daily chart, and you could see how that looks like on a 30-minute chart. That was in the British pound. And then we saw 2 examples in the S&P 500, one on a 5-minute chart where you could break it down into the 1 minute components, and then over here on the 1 minute chart where we broke it down into 10-second components. And you see it's the same pattern. So what's nice is you can very easily filter for an umbrella. I'll show you what the formula is here for the bullish umbrella. Let's see, modify the formula. You're basically just saying that the open is greater than the close of 1 bar ago. The close is greater than the close of 1 bar ago. The high is lower than the high of 1 bar ago. The low is greater than or equal to the low of 1 bar ago. And I'm sorry, all of these are greater than, equal to, less than, equal to. And then the close of 1 bar ago is greater than the open of 1 bar ago. And that just ensures that it's green. And another feature that you don't have to put on here, and all I did here is I just said that the close minus open of both this bar and that bar divided by the high minus low of this bar and that bar are greater than 0.5. And what that does is it ensures that you have a lot of meat in the body, because trying to see where it was, somewhere here, for example, this right here would technically fit the definition with regards to this body being inside of that tail. But, as you can see, these tails are fairly equal. And also it's just a lot of tail, which is just a lot of rejection, not a lot of price acceptance. And here you've got these big bodies, and so all I was doing is testing to say this body plus this body divided by the sum of the 2 candles should be greater than 50%. Various ways you can slice that and filter for that. But again, the beauty is once you have this filtered, you can have your program bring up all the different situations where an umbrella exists, and then you can drill down to the lower time frame and see if you have a pattern that you'd like to trade on that time frame. So anyway, that is the umbrella scalping pattern. Works on a 1 minute chart down to 10 seconds, as you saw. Works on a daily chart, down to a 30-minute. I hope you enjoyed that. Ask me questions. I'm happy to answer.